You've done everything right. You max your 401k, you bought index funds, you even opened a Roth IRA. But you did it in the wrong order, and that mistake is quietly costing you tens of thousands of dollars over your lifetime. Here's the uncomfortable truth. It's not just about how much you invest, it's about the sequence. Get the order wrong and you pay more in taxes, lose free money you were entitled to, and leave yourself exposed at the worst possible moment. Get it right, and the same dollars compound faster, protect you longer, and set you up for a retirement most people will never reach. Most people invest the right way, just in the wrong order. In this video, we break down the exact sequence financially disciplined people. Click the subscribe button so you won't be left out in our next video, so let's dive in. Today, I'm laying out the exact order financially disciplined people follow step by step, and showing you exactly where you've probably gone wrong. Most people think investing is simple. Put money in, let it grow. But two people can invest the exact same amount over the exact same years and end up with wildly different results purely because of sequence. Here's why. Every dollar you invest passes through layers: taxes, employer benefits, interest rates, liquidity. Each layer has a different cost or reward attached to it. Skip a high reward layer to rush into a lower one, and you've permanently given up value you can never get back. Think of it like pouring water into a stack of buckets with holes of different sizes. Fill the small hole bucket first, and almost everything you pour stays. Fill the big hole bucket first, and most of it leaks straight through before it ever reaches the good buckets underneath. Step 1, and this isn't debatable. If your employer offers a 401k match, that comes first. Before extra debt payments, before an IRA, before anything else. Here's why. If your company matches 50% of your contributions up to 6% of your salary, that's an instant, guaranteed 50% return the moment you contribute before the market even moves. No investment on earth reliably pays that. Walking away from it isn't just a missed opportunity, it's leaving guaranteed money on the table that will never come back. The mistake people make here isn't skipping the 401k entirely. It's contributing less than the match requires, chasing other goals first, and unknowingly forfeiting thousands of dollars a year in free money. Step 2, high-interest debt credit cards, personal loans, anything above roughly 7 to 8%. Here's the math nobody wants to hear. If you're paying 22% interest on a credit card balance while investing in a fund that returns 8% a year on average, you are guaranteed to lose. Paying off that debt is the same as earning a guaranteed 22% return, risk-free. No investment strategy beats that reliably. This is where a lot of well-intentioned savers go wrong. They feel proud contributing to a Roth IRA while carrying a $5,000 credit card balance at 24% interest, not realizing they're paying far more in interest than they're earning in the market. Step 3. An emergency fund, 3 to 6 months of essential expenses, sitting somewhere safe and liquid. This step doesn't grow your money, it protects it. Without this cushion, a job loss or medical bill forces you to sell investments at the worst possible time, often at a loss, or worse, go into new high-interest debt to cover it, undoing everything you built in steps 1 and 2. The order matters here too. Build this before you aggressively invest further, because one unexpected expense without a cushion can wipe out years of compounding gains in a single bad month. Step 4, and this is the one almost nobody optimizes, the health savings account if you qualify for one. The HSA is the only account in the entire tax code where the triple advantage contributions reduce your taxable income. Growth is tax-free, and withdrawals for medical expenses are tax-free too. No 401k, no Roth IRA, no brokerage account offers all three. Most people treat it like a spending account for this year's doctor visits. The disciplined approach is different. Pay medical costs out of pocket when you can, let the HSA balance invest and grow untouched for decades, and you've built a stealth retirement account that beats almost everything else available to you. Step 5. An IRA, Roth, or traditional, depending on your income and tax bracket. A Roth IRA is especially powerful early in your career when your income, and therefore your tax rate, is lower than it will likely be later. You pay tax now at a low rate, and every dollar of growth after that is completely tax-free in retirement. This is also where flexibility matters. Unlike a 401k, you control the investment options directly, often with lower fees and a wider range of choices, which means more of your return stays yours instead of disappearing into administrative costs. Step 6. Once the match is captured, debt is cleared, the emergency fund is built, and the HSA and IRA are funded, go back and max out your 401k contributions further. This step comes later than most people assume, not because the 401k is bad, but because the earlier steps offer better guaranteed returns, more flexibility, or more urgent protection. Maxing the 401k now takes advantage of tax-deferred growth on a much larger scale once the foundation underneath it is already secure. Step 7. The final layer. A standard taxable brokerage account. This is where extra money goes once every tax-advantaged option has been used. It won't shelter you from taxes, but it offers something the earlier accounts don't: total liquidity, no withdrawal penalties, and complete flexibility to invest in anything, anytime. This step comes last, not because it's unimportant, but because every account before it offered a better deal per dollar invested. Now, here's what happens when people run this in reverse, and it's more common than you'd think. They open a brokerage account first because it feels exciting. They skip the employer match because cash feels tight. They carry a credit card balance while contributing to a Roth. Each of these choices seems reasonable in isolation. Together, over 20 or 30 years, the gap between the right order and the wrong order isn't small. It's the difference between retiring comfortably and running short a decade into retirement. The order is simple once you see it laid out. Capture the match, kill the high-interest debt, protect yourself with an emergency fund, exploit the HSA, fund the IRA, max the 401k, then go taxable. It's not glamorous. It won't make headlines. But it's the quiet, disciplined sequence that separates people who retire on their own terms from people who are still working well past the age they hope.